I would you. I do want to be idea.
Yeah, Boko.
Nice one. And I didn't know my head.
Yeah, so today we'll be talking about essentially some of the keys. A lot of people want to get into investing. So really some of the keys and some of the steps you can take today to become a successful investor. So thank you all for tuning in to WGHC 98.3 FM, your voice, your music, your station. My name is Jeff Badu, and I'm a licensed certified public accountant in the state of Illinois. I'm the owner and practitioner of my firm, Badu Tax Services, and we specialize in tax preparation, tax planning, and tax representation for individuals and businesses. So today's topic will be on essentially some of the steps you can take in order to become a successful investor. But before we do that, I would like to kick it off with a market report. So this report is as of September 22nd of 2017, so as of last Friday. So the benchmark indexes essentially ended last week mixed, with the large caps of the S&P 500 and the Dow Jones posting modest gains, with the tech-heavy NASDAQ, they fell back a little bit. The small cap Russell 2000 performed the best, gaining 1.33%. And then energy stocks climbed as oil prices hit a 3-month high. The yield on the 10-year treasuries climbed as prices fell. And overall trading was, there wasn't much that was going on. Probably in response to the strong dialogue between the U.S. and North Korea. And so the price of crude oil went up to $49.83 to $50.66 per barrel. The price of gold went down from $1323.50 to $1350. So overall, the stock market, or the markets in general, are still doing pretty good. Dow Jones is up 13%. NASDAQ is up 19%. S&P 500 is up 11.76%. And the global Dow is up 15%. And so to get into today's topic is really, a lot of people want to learn how to invest. Not everyone wants to take risk. So today we'll be talking about some of the steps you can take to overcome some of your fears, some of your obstacles, and things like that in order to become a successful investor. And so one of the things to keep in mind is that investing is a lifelong process. It is not a sprint. It is a marathon that requires you to be proactive and also to take action when it's necessary. And so really there are a few steps that you can take today in order to become a successful investor. And so really the first step is to educate yourself. Anything that you do in life, you must know what you're doing or you'll probably end up failing. And so the first step I would say in educating yourself is start becoming familiar with some of the terms. I use a site called Investopedia, and really Investopedia helps me gain some knowledge. Anytime I need a definition or anything like that, anytime I'm looking at a new investment, the first website I go to is Investopedia. And then I just search it, and it gives me a nice synopsis of what the investment is all about. So search keywords such as stocks, bonds, mutual funds, even Bitcoin, Forex, real estate. All the different investments out there are available for you to know about on Investopedia. And it's a really nice, short, quick summary that tells you all about the investment. And you can always find out more about it by doing more research on some of the terms. They have some hot links in there that you can click on. But really, Investopedia is a site that I go to for all investment knowledge. It's the very first site. So if you want to learn about a stock, just search the word stock. Start reading about it. It might not make sense the first time. Maybe you have to read it a second time. And of course, I personally post blogs and different articles and things like that on my website. And there's one specifically on stocks. Now keep in mind that stocks aren't your only investment option, but it is one of the best places to start with because it doesn't take much knowledge or much money or time, depending on the strategies you use, of course. But overall, the stock market is pretty easy to get into. and it's very, very easy to understand. You buy a company or you buy shares in the company. As the price rises, as you get paid dividends, that's when you make your money, essentially. And so really, that's my first recommendation, is to educate yourself. You can also read certain books. They have even things like Investment for Dummies and things like that. Rich Dad, Poor Dad, Money Master the Game, all these different books. Me personally, I've read 18 personal finance books so far this year. And it's really enhanced my knowledge and allowed me to start a bunch of different businesses and continue my investment journey. You can also read certain articles. Me personally, I have some articles on my website, jeffbadu.com, so that if you want to learn about any investment, I have all types of investments on there, and you can always get to educate yourself on that. And then also attend different seminars, different workshops, and different things like that in order to continue that education. Remember, some of the wealthiest people, as a matter of fact, all wealthy people continuously enhance their education. They say you're either learning or somebody's learning you. Learn or get learned, basically. So it's when it comes to investing or anything in life, it's really about learning, and you must be able to learn. And then also understand the two reasons why we invest. So investing is not really an option. It is actually a requirement. And the reason that is for one, we invest to try to fight inflation. Say inflation is growing at 2 to 3% each and every year on average. So inflation is really basically how much can your money buy. And so when inflation goes up, it reduces how much you can buy. So buying something for $1 today will probably cost $1.50, let's say 5 years from now. And so if you're not investing, then you're not able, at some point you're not going to be able to afford that $1.50. Now imagine if we're talking about on a grand scheme of hundreds of thousands. So what costs a house that costs $100,000 today might cost about $150,000, let's say 5 years from now. And so if your money is not growing, then you won't be able to keep up with inflation. And so that is one very important reason why we need to invest, is to fight inflation. If we don't invest, then our money will continuously lose its power. People always say, oh, I had $1 back then was worth like $2,000 or something. Well, that's what they mean by inflation, is that if your dollar was literally sitting there under your mattress or something like that, it's essentially losing its power. And so that dollar 100 years ago or 50 years ago is worth extremely less in today's world. It can buy extremely less than what it could buy back then, basically, is what they're saying. And so that's one thing to keep in mind, is that when they say these things like $1 back then is worth $2,000 now, it assumes that you actually invest in that money and earning something on it over time. And so the second reason is to also take advantage of what's known as compound interest. And this also ties back to the first point. But compound interest is really money that grows on top of money. And so let's say they say an investment that grows at 8% per year, it's going to compound over time. Or an investment that grows at 10% per year. There's a fancy term known as the rule of 72, where you essentially take 72 and you divide it by the interest rate, or you divide it by the whole number of the interest rate. So 72 divided by 10, it would take you 7 years to double your money, basically. And so compound interest is very powerful. As a matter of fact, Albert Einstein, one of the most famous human beings out there, he said compound interest is the most powerful force on the entire universe. And so really with this, when we invest, we're able to grow the money over time. It's not guaranteed, but history has shown, and different trends and things have shown, that money actually compounds or grows over time. And then also keep in mind that investing is really only risky when you don't understand what you're doing. So if you're not educating yourself, if you're just jumping in the water, if you're diving in without any sort of foundation or education, then that's when investing is really risky. I mean, think about it with anything in life. If you don't know how to drive and you get out on the road, that's very risky. You're probably going to get into an accident. God forbid, but that's probably what's going to happen. If you've never stepped foot on a gas pedal, you're probably going to fail in that instance. So things are only risky when you don't understand what you're doing. But if you've done it before, if you've done some practice trading, so even with investing, there are sites that allow you to practice before you dive in with both feet. Warren Buffett said, never dip both feet into the water. You always want to put one feet in, and then as you see it's going good, then you put both feet in. And so there's different sites out there that allow you to practice, allow you to perfect your craft. Just think about it. If you're about to give a speech, it's very risky for you to give that speech without preparing or without practicing. The same thing goes with investing. It's the same concept. It goes with flying a plane. It goes with driving a car. It goes with taking an exam. Anything in life is risky if you don't know what you're doing, if you're not adequately prepared. And so one way we prepare ourselves is to actually educate ourselves, and we actually practice, and we actually take action with some of these things. And so once you've become educated, and the education never ends, by the way. This is a continuous process that goes on until the day you die. And so just keep that in mind. You always must educate yourself, or you're going to fail eventually. And then, so the next step is to once you've educated yourself, start setting attainable goals. So now you know a little bit more about the stock market, the bond market, things like that. Really start setting goals. So here's a goal. I want to invest $100 a month and establish a rate of return of 8% per year. That's a very tangible goal. That's a very attainable goal. You can easily track it. Did you contribute $100 a month or did you not? Yes or no? Did you establish 8% rate of return each year on that investment? Yes or no? So those are, I would say, set attainable goals, things that you can actually measure, and not just very broad goals like, I just want to invest this year. Well, that's great, but we need to be more specific than that. So always set attainable goals once you've developed that education, because with the education, it allows you to see how much you can earn, how much you can invest, how much you should be investing, different things like that. And then also understand your time horizon. So there's long-term time horizon and then short-term time horizon. And so younger people have a longer-term time horizon than older people, meaning time horizon is just how long you have to invest, basically. So younger people can make more mistakes, or they can afford to take on riskier investments than the older folks. And then also understand your risk tolerance. So really, risk tolerance is measured as, or it's categorized as risk-seeking, risk neutral, and then you also have risk averse. Or you can also put it in as aggressive or conservative. And so with a younger person, somebody who's up and coming, starting out, they're probably going to be more aggressive because they can afford to lose more money than somebody who's getting ready to retire. So always understand these things. It depends on your stage in life, if you have a family or anything like that. So always try to analyze these things. Now, I do recommend that you sit down and talk to an advisor. You sit down and talk to an expert. But you still need to know these things regardless. Because what if that advisor leaves you? Or what if you feel like you're being cheated? I always tell people, never hand your money to somebody. Walk away for a year and ask where it is. Ultimately, you always want to keep track of it, and you always want to educate yourself and use the experts more as a guide or as a tool or as a resource that you can tap on if you have any questions. So just keep that in mind. Always understand your time horizon and then also your risk tolerance. And then keep your liquidity needs in mind. So liquidity is simply how soon you need money. So maybe you want to buy a house. Maybe you want to... maybe you have a certain investment, or maybe you have a kid and maybe you're saving for college or something like that. Just always have your liquidity needs in mind, because you never want to invest above your liquidity needs. Now keep in mind that you could still put money into very safe investments. Just be sure that you're easily able to tap into it in your quote-unquote liquidity fund. and so maybe perhaps you may need to lower your investments, or put more money into lower risk investments because you have high liquidity needs. If you don't have high liquidity needs, maybe you live with your parents. Maybe you don't have any student loans. Maybe you don't have any loans whatsoever. So now you can actually invest some more, and put more money at quote unquote risk, or put more money towards the future and towards your investment bucket. And so once you've educated yourself, once you've set attainable goals, now it's really time to ensure that you have an adequate reserve fund in case the worst happens. Not saying it will, but you always want to cover your bases. So establish adequate savings or an adequate reserve fund in order so that you're able to invest comfortably. And even this might even help if you find a really hot investment and you're like, okay, I've already contributed my $100 a month. Now I want to pad it even more. And so now what you can do is you can actually dip into your reserve fund and put some more of that money into that investment. Maybe it's a short-term investment. So different things like that. So some tips with this is to establish what's known as a rainy day fund. So essentially reserve 3 to 6 months worth of your expenses in the form of cash, credit card, available balances, and just anything that's easily accessible. Now remember, your reserve fund doesn't only have to be in a bank. It doesn't have to be cash under your mattress. It can be in the form of credit cards that have very high limits and things like that. Credit cards that you won't use, and they are established for emergencies only. And then also ensure that your high interest rate debts are paid, not necessarily paid off, or basically paid down so that they're not draining you. Remember inflation? Well, high interest rate credit cards or high interest rate debt can also drain you. And so try to stick more on the low interest rate side if you're going to borrow money, which is very easy to do nowadays because interest rates are still pretty low. And so really what you want to do is ensure that you at least have a plan to pay off those very high interest rate debts in order for them to not drain your net worth. Because if you're investing and earning 8% a year, it doesn't really make sense for you to not pay off something that's draining you 26% a year, such as a credit card. And so you might want to focus a little bit more on that, or allocate some money towards that too while you're investing. Perhaps you're doing it simultaneously, but you're putting more money towards a credit card, which is draining you 26%. If you factor in inflation, let's round up to now, let's say 3% inflation, and now you're looking at 30% of lost money essentially each and every year. When you factor in the credit card interest rate plus the diminishing purchasing power of your money. So just keep that in mind, and that you might want to knock out some of these very high interest rate debts along your investment journey. And then also protect yourself. This is extremely important. When you start building assets, when you start buying a home, buy a car, yourself, you are your biggest asset. No matter what happens in life, no matter what you acquire in life, you are always going to be your biggest asset. So it's only right to protect yourself. And so be sure that you have adequate insurance policies in place, such as a home, auto, health, life, disability, all the different policies out there. You even have umbrella policies that cover everything essentially. So please be sure that as you're building these assets, as you're building your investment bucket or pools and things like that, be sure that you're actually protected in case the worst happens. Now, luckily, retirement accounts are protected by, against bankruptcy and things like that. So just keep those things in mind, and that you should actually be shielding most of your money in these retirement accounts. Because for one, if you are investing, you should be investing for the long term anyway. So this isn't money that you should be looking forward to touching in the near future. So keep that in mind. And one point that I would like to bring up is to always take advantage of your retirement accounts, such as your 401ks at work. Be sure that you're taking advantage of the match, because if you're not taking advantage of the match at a minimum, you're essentially losing money each and every year. And the match is basically how much your company is going to match you as you contribute towards your 401k. So always make sure that you are contributing to your retirement accounts. I recommend that if you are doing investing, make sure you make sure you pad your retirement accounts in order to do some of these investments. You know, you can even buy Bitcoin nowadays with your IRA. You can do peer-to-peer lending, and I'll go into the different investment types later on, but understand that you might want to pad your retirement accounts and try to contribute on an after-tax basis, especially if you're in a lower income tax bracket. So if you're above or if you're below six figures, you might want to do it on an after-tax basis, because your tax rates are probably going to be higher by the time you retire. And then two, your money can compound or earn interest over time tax-free. And so me personally, one of my goals is to retire by living tax-free. You know, so the highest tax rate back then was above 90%. You know, so the highest income earners back in basically back in the 1900s, early 1900s, the highest tax rate was about 94%. And so imagine if you had money in pre-tax, what that could do, how much damage that could do to you. And imagine the type of vacations you could go on if you had the money in after taxes. So just one thing to keep in mind. And then back to the insurance point, always seek the help of an insurance professional when you're making some of these decisions, because they can sit down with you and go over some of these policies. And most of them would do it free of charge. And so once you have adequate knowledge, once you have the proper plan in place, once you've saved, or once you've established a rainy day fund, or once you've developed a plan for a rainy day fund, you can now explore now you can actually invest. You can actually explore different investment options or establish what's known as an investment game plan. So you only have two types of investments: long-term investments and short-term investments. So long-term investments include dividend-paying stocks, exchange-traded funds that you plan to hold for the long term, perhaps some mutual funds, which I do not recommend, unfortunately. Buy and hold Bitcoin and other digital currencies, cash flow in real estate such as rental properties, peer-to-peer lending, some bonds, some car rentals here and there, some permanent life insurance such as whole life insurance, universal life insurance, variable life insurance, variable universal life insurance, annuities. The list goes on. Just know that you have a bunch of options when it comes to some of these investments. And so really, a long-term investment is anything you plan to hold technically for over a year. To me, I would say a long-term investment is anything that you plan to hold for 5 years or more, and you plan to pass down to your kids. And then you have short-term investments. So these are things like day trading, stocks, forex, things like that, wholesaling and fix and flip real estate. And then you also have just anything that's within a very short period of time. So technically anything that's within a year. And so once you've done all of these things, once you've got some skin in the game, now begin to implementing the plan. Remember, a plan is nothing more than a failure if you don't execute it. So you must implement, you must execute it, and then start allocating funds, doing what's known as asset allocation, based on your risk tolerance and your time horizon. For example, perhaps you want to put 50% into dividend-paying stocks, 30% into exchange-traded funds, and then 20% into peer-to-peer lending. And so assuming you're a long-term investor, you have your assets allocated based off these different investments. And so that's how you might want to allocate your assets based off your risk tolerance and your investment or your time horizon. And then always monitor the plan by analyzing your performance over time, as well as reallocating assets when necessary. So as you get older, you might start wanting to reallocate towards the less riskier investments. And then always track your rates of return over time and then compare them to your different targets. And so really that's really the steps. the first thing is to educate yourself. Then you set a plan. Then you bulk up your savings. And then you actually pick out some of the investments. And then you implement the plan, and then you continuously monitor the plan. And so one of the biggest tips is to never go it alone. With anything in life, don't go it alone. So always have good advisors on your team. 2 traits of the wealthy, really, is they educate themselves all the time, and they have a great team around them. So always have good advisors on your team. And don't just, like I said before, don't just hand your information to an advisor. Never just hand a check of $10,000 to somebody and expect them to grow it over time or do things exactly how you want it if you're not being proactive in the process. So part of growing money, part of becoming wealthy, part of investing is to become proactive in what you do. You have to be proactive. It doesn't matter if you're working with the best investor in the world. It doesn't matter if Warren Buffett is managing your investments. You should still always be proactive because you never know. Things change over time. And so they should only really serve as a guide or a resource or a tool that you can tap into anytime you need help. And then continuously educate yourself. Remember, with this investing thing, education never stops. It is a continuous process that goes on forever. And then watch out for taxes. You might be making all this money. You might be performing very well in your investments and things like that. So always watch out for your taxes and things like that. So always seek the help of a tax professional. Always do the right thing. Seek out the help of professionals because taxes can really drain your investment returns over time. And then always run the numbers as well. And so you always do the math, always do the due diligence and things like that in order to make sure that you're making the best investment decisions. And then do some form of automated investing here and there. I mean, even me personally, I do a $5 a day plan where I have an account called, it's with a company called Acorns. And so for the rest of my life, I've committed to investing at least $5 a day. And, I know for a fact that I'm always going to have $5 a day. Even when worst to worst comes, I'm always going to have $5 a day. So what I do is I invest at least at a minimum $5 each and every day. It's taken away from my bank account and goes directly towards this investment account. And so do some form of automated investing. Maybe you slack off 1 month. You're like, okay, I didn't put that $100 a month into my investment account where I actively manage. Maybe you want to do some passive management too, where they'll actually take the money and they'll invest it for you. While you still have control, you can still watch it and things like that. So it's an app called Acorns. You have other apps called Betterment, Stash, all these millennial-built apps where you can actually do some automated investing, which I recommend, especially starting out when you don't have as much knowledge, savviness. So even as you're learning, perhaps you're like, I'm just dying to invest $100 a month. Or I'm just dying to invest $5 a day or something like that. So there's nothing wrong with doing an automated investing in the beginning. And even me, somebody that's, seasoned with investments, I still do some automated investing. And then, as the saying goes, don't put all your eggs in one basket. That's one of the easiest ways to fail, is that you don't just want to do stocks. You don't just want to do bonds. You don't just want to do real estate. You want to have a bunch of investments. Me personally, I have at least 10 different types of investments. I have stocks. I have some peer-to-peer lending. I have some car rentals. I have some real estate. I have some Bitcoin, exchange-traded funds, mutual funds, dividend, permanent life insurance, annuities, a bunch of them. So at least 10 in my portfolio or my asset allocation that I can always tap into. And then always remember that cash is king. No matter what, cash will always be king. So don't forget to keep your reserve funds up to date. Make sure that 3 to 6 months is always there, just in case the worst happens. And when a recession happened, the reason why people were losing so much money is because they didn't have cash in their bank, so they had to sell their investments when the value was plummeted or very low. And then always never dive into the water with both feet. Always dip in one toe at a time. and start small. Basically, start small but think big. But just make sure that you're not just diving in. Don't just throw your whole bank account into a stock investment when you know nothing about it. And then last but certainly not least, take advantage of technology. We have a lot of resources at our fingertips. There's no reason why we should not be educated on investing. We just have to be proactive, and we have to take action. So thank you all for tuning in to WGAC 98.3 FM, your voice, your music, your station. My name is Jeff Badu, and I look forward to continuously developing you all, or continuously giving you all some knowledge and some content on personal finances. So thank you.
.3 FM, Chicago's #1 African music station.
That's right. 98.3 FM, one of our best segments. And on the Money Talks, we are exposing all our professionals in the community to the world. And Jeff Badu happens to be the best in accounting and finances. And he has his own company. So make sure you look out for him. And come November, December, January, February, March, April, May, June, he's the best guy for you to look for. Trust me. And I'm around here.
No.
All right. Yeah, so right after me now, you're not for. Maybe I will.